Okay. All right. Okay. President training. Here we go. Whoosh. All right. So we've got an hour left. Hopefully we'll get through all of it. I think we will. Let's see how it goes. So today for the resident world, we're going to talk credits. We're going to talk education benefits, and we're going to talk finishing the return. Finishing the return is going to be pretty simple because we already talked about a whole lot of that stuff from the non-resident side. And the main things like dates and all of those don't change. So that'll be good. All right, just a quick detail review. So we'll talk about Moodle and the quizzes, review from last week, and then off we go. So as a reminder, I've added people to this course based on their volunteer data quiz. So we've had 5 quizzes so far, 5 modules. So 1 to 3 from the 2 weeks ago, not last week. Then this past one, we had income quiz and then adjustments and deductions. So that should be where you are in Moodle. All right, you've already seen this once tonight, right? We start with our income, we subtract adjustments, deductions, and exemptions, even though exemptions are 0. To get taxable income, we find our tax rate, look at our total tax, subtract credits, withholding, and estimated payments to find out if it's a good day and we get a refund or if it's a terrible day and we owe money. This was a huge list of income that I walked through. So there are lots and lots of types of income, right? Because the IRS, if you're a tax resident, the IRS basically says, we don't care where the money's coming from, we want some of it. The only good news is that generally this is all going to get reported on some sort of an income document, a W-2, a 1099, and TaxSlayer generally is going to help you get that into the right spot on the tax return forms, or at least it will when it is fully working. Because that is the other fun part of this, in addition to Link and Learn. TaxSlayer is in the process of getting updated and is so not completely functional yet as well. All right, adjustments. This is that huge list of them. Again, these are things that you spent money on that you can use, subtract from your income so you don't have to pay as much tax. A lot of those items will get documented on a form like a 1098E. Sometimes, though, it'll be up to the individual taxpayer to have their own receipts. We probably won't see a lot of them, but there will be some. Again, based on the type of income document or what it's described as, that will help you get that into the right spot. The standard deduction is a set amount that reduces your taxable income based on your filing status, based on whether your age is, if you're blind or not. Generally, for residents, you can take the standard deduction, but if you are married filing separately and your spouse itemizes, then you have to itemize too. The itemized deductions are generally the option. If they're higher, that's a great deal, go for it. If they're lower, then don't worry about it, take the standard deduction. Usually they are lower just because of the changes in the tax laws, but if the person wants to, they have their information and they want to check it out to see what's the biggest, there's absolutely no problem doing that. TaxSlayer will help do that math if they enter all of that information. All right, that was last week in about 35 seconds. Does anybody have any questions? Or 2 weeks ago, goodness gracious, I'm out of touch. Does anybody have any questions about income adjustments and deductions for residents? Okay, let's go to credits. All right, there are 2 kinds of credits. There are non-refundable credits and refundable credits. All right, a non-refundable credit basically takes your tax liability, the amount of tax you owe, down on a dollar-for-dollar reduction to 0, but it can only reduce it down to 0. It does not ever give you any money back. So if you do not owe any tax, then a non-refundable credit does you no good because it can't reduce a number that's 0 down to something that's lower than that. They are primarily on Schedule 3 is where you find them. For non-resident aliens, we basically skipped over that because there are not really any of those that they are for. So how does that work? Just in a quick example. So Chris has federal income tax, so he owes tax of $470. He meets all the requirements to claim a $500 credit for other dependents and a $100 retirement savings credit. The total amount of the non-refundable credits is $600, but that's higher than what he owes. So he will get $470 for the credit for other dependents, and his tax gets down to zero. That last $130 just goes away. Doesn't do anything for him. It just sits out there saying, sad, earn more money, then I can help reduce your credits even further. All right, the child tax credit, we talked about this a little bit. So it's a non-refundable credit. The maximum is $2,000 per child. A couple of years ago, there was a change in law for COVID. It was higher, it was like $3,000, and it was partly refundable in advance, but that is no longer the case. It is claimed on Form 8812. All right, you have to be a qualifying child for the child tax credit. You can't just be anybody. These are the requirements: under age 17, citizen, national, or resident alien, meet the resident test and claimed as a dependent, provide over half of your own support, live with the taxpayer for more than 6 months of the year, although there are exceptions for temporary absences like going to school, at college, or other absences for divorced or separated spouses, and you have to have a social security number. All right, here's the relationships. The way that I think about this one is think of yourself on your generational tree, go out to like brothers and sisters, so everybody out and down qualifies, but nobody that ever involves going up. So like cousins don't count because your relationship to them goes up through your parents, so those don't count. So it's got to be your children, the ones that are direct from you, or your brother, half brothers, and their children's and descendants. All right, here's the table that shows some of the changes for the credit. Basically, it was really high and really great for a little while, but now it's back down. This is not one that's very commonly seen for our tax clinics, in all honesty, but this is definitely a big part of the test because this is a very common credit for general VITA clients. The credit for other dependents, essentially, if you don't have a social security number and you can't qualify for the child tax credit, if you can get an ITIN, you can get this credit for other dependents, which is only $500, but it still gives you a credit for a qualifying dependent. I'm going to skip this because I think we're going to be short on time. Credit for child and dependent care expenses. So again, this is where you go to work or you go to school, you pay somebody to take care of your child. This is a credit that you can take that will reduce your taxes based on the money that you spent. One of the key things for this is the maximum that you can claim is $3,000 for one child and $6,000 for 2 or more children. So it's always going to be that. And it doesn't have to be like 3,000 each. So it can be like 4,000 and 2,000. If it was 4,000 and 4,000 for expenses, it would have to be cut back down to 6,000 maximum, but it doesn't have to be that exact 3,000 for each of them. It can be different amounts. The other thing is that the child has to be under age 13 or a spouse or dependent that is not able to provide self-care. So once they turn 13, they say they're old enough, I guess, to not need care to stay at home alone. The form that this is used on is 2441. All right, there are 5 tests again. Qualifying person, you have to have earned income. If you are a student, there is an amount that you can put, it's in the book somewhere, that you can substitute for your amount of earned income for that. There's a joint return test. You have to file a joint return if you're married. And the provider, whoever is giving that care, must provide their name, address, and their tax ID number. If it's a person that you're just having babysit, you can have it be their social security number. Or if it's a business, then it would be the employer identification number for that business. And that's very common. All of the daycares and all of that, they automatically provide all those forms to their people. All right, I'm going to skip that too. Skipping. All right. Credit for the elderly or disabled.
Maria,
Yeah.
can I ask a question on the
Sure.
the credit for child and dependent care expenses?
Yeah.
Now, I'm just thinking back on I know we're in residence now, but in the 4011
Yeah.
for that credit, they say that it can't be used when you're studying. So is that peculiar just to the non-residents, and you can use it for studying for residents? Or is it just a mistake? Could be a mistake in the 4011.
Would be a mistake. I would want to just do a little bit of double checking
Okay.
on that. Yeah. I would want to, let me check and look on that a little bit more because yeah, there's a couple things in the 4011 that are research required.
I just saw that today for the first time. Thanks.
Nope. Thanks for bringing that up. All right, I'm making a note. All right, there we go. There. Okay, perfect. All right, credit for the elderly and disabled. Why am I having trouble talking? All right, so basically this is a credit for individuals who are over age 65 or on total or permanent disability. If they are on disability, they need a physician statement that states that fact. You don't have to send that into the IRS, right? The IRS is like a trust but verify kind of organization. They'll take your word for it, but they may say, yeah, we'd like you to send us the proof of that. There's a Schedule R that you would use to fill out the credit, determine their eligibility, and calculate the credit amount. This is the criteria here. It's very limited. Generally, I would say that most likely we will probably not see anybody with that, but it is a possibility, and that is the information about it. Retirement savings contribution. So the idea here, right, is that government thinks it's a great idea if people save for their retirement. So if you have income within a certain range, they say, sure, we'll give you a credit, help reduce your taxes, some extra amount based on the money that you save. You have up until the due date of your tax return to make the contribution or to make the contribution to your retirement account. So you don't have to do it by the end of the year, 12/21 or 31. You can do it up until 4/15, but not extension. So only through 4/15. The big one on this is that you have to be older than age 18 and not a full-time student. So this will probably get a lot of the people that we would normally see in our tax clinics. But theoretically, if we have some postdoc researchers, teachers, staff, all of that, they could potentially qualify for this. Most likely it's not going to be that. But it is a decent credit, up to $2,000 for contributions. You get a credit of up to $1,000. So that's good money back and qualify. All right, there's all that. All right, refundable credits. Okay, so non-refundable credits take your income down to zero or take your tax down to zero. Refundable credits give you money back, right? Super awesome. So it's actually considered a payment made by the taxpayer. They can take your liability down to zero as well as actually give you money back in your pocket. It can be that you, as a taxpayer, you might not have any income, but you could still qualify for a refundable tax credit. And so you should still file your tax return, even if you are not otherwise required to file. All right, I'm gonna skip over that. All right, additional child tax credit. So the child tax credit was up to $2,000 of a non-refundable credit. The additional child tax credit is basically a portion of that says up to $1,600 of that addition of the child tax credit can actually be refundable. All of the same criteria, or the same criteria are in place for the additional child tax credit as the regular child tax credit. But to claim it, you must have more than $2,500 of earned income or have 3 or more qualifying children to meet that. Again, when TaxSlayer is working, we don't necessarily have to worry about this quite as much, right? We will enter all of the information about the dependents. We'll enter the information in about the income, and it will automatically do the work to say, hey, we think you might be eligible for the child tax credit. All right. So for an example, just to walk you through one of them. So Jeremy has a federal income tax of $300 that he owes. He can claim the full $2,000 non-refundable child tax credit. So the total amount of the credits is higher than his income tax. So 300 of that child tax credit reduces his liability down to 0. He has $1,700 available on the child tax credit / additional child tax credit, but only $1,600 is refundable. So Jeremy gets a $1,600 refund. That $100 that's left of the non-refundable child tax credit just never gets used. All right, does that make sense to everybody? Okay. All right, earned income tax credit. All right, this is a biggie. So this is one of the credits that is very, 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 very common for VITA tax clinics. So most of the low to moderate income individuals that come to a VITA tax clinic, often many of them will qualify for that. So basically what it does the calculation for this credit is based on your amount of your income and your family size. There is a Schedule EIC that you can use to collect information about the income and the number of eligible children. Again, the taxpayers themselves will be filling out these forms because we are an FSA clinic, but this is where it is, and we will give you some practice doing this as well. All right, if earned income tax credit was denied or disallowed for any reason other than a math or clerical error, then the taxpayer has to include a special form, 8862, that basically tells them, provides some additional information about their situation for why it was reduced or disallowed. The unfortunate truth is that earned income tax credit is one of the areas that can be subject to a large amount of fraud with the IRS. And so they do have additional safeties and precautions in place to make sure that they try to minimize that fraud. All right, here's the information about the maximum amount of the earned income that you can have and the maximum amount of the credit. So you can see that it is quite a decent amount if you have children. If you don't have any children, you can get that credit up to $600, but it is pretty limited for the amount of income that you can have to qualify for that. All right, here's the criteria for the earned income tax credit. You have to have earned income, of course. You have to be a citizen or a resident alien for the entire year, have a valid social security number for yourself, spouse, and any children. Your investment income can't exceed $11,000. You can't use married filing separate. You can't file a Form 2555, which is foreign earned income or exclusion. And if you don't have any qualifying children, then you have to be at least 25 years old, but less than 65. Can't be the dependent or a qualifying child of another person, and you must have lived in the US for more than half the year. Tessa, do you have a question? This is the AGI, so it's after the adjustments. It's adjusted gross income before the standard deduction. Yeah. All right. Have a qualifying child. These are the criteria. There's a variety of relationships that would meet the criteria. Again, kind of that your level in the family tree and then down. There's age criteria as well, residency, and then the child can't file a joint return also. A reminder that earned income is income you receive from working. So income that's generated from like interest, rental income, dividends, things like that does not count as earned income. Some strike benefits qualify. So I'm sure the lucky folks that are doing VITA clinics out in California will get to have lots of strike income that they get to figure out for this year. All right. Okay, so there are requirements. IRS does have some explicit definitions for unearned income. Some additional examples of that are things like alimony or child support, unemployment or workers' comp, any income that you received while you were in jail or in prison, inheritances, gifts, gambling winnings and awards, investment income, or pensions and annuities. All right, I'm going to skip that. Premium tax credits. So if somebody has tax or has health care through the Affordable Care Act, depending on their income, they may get a premium tax credit that helps pay for that care. If you have that, you are going to receive a 1095A. When you sign up for that health care, you estimate your income, and then the marketplace will figure out how much assistance you should get. And then when you file, you have to reconcile whatever it was that you estimated your income to be versus your actual. If you made less money, then you get extra credits. If you made more money, then you might have to repay some of those credits, is basically the idea. So here's some additional notes about it. We should walk through one of those examples. I'll give you one or a few questions about it because there are usually questions about this in the advanced test. So the main thing to know here is that somebody that's doing this should receive a form 1095A that's going to report who is covered by the insurance policy, the cost of the insurance policy, the second lowest silver plan amount, which is a calculation number or figure used in the calculation for the tax credit, and then the premium assistance that was paid, and then the time that the person was insured. If somebody does have a 1095A with other people on their return, those people need to work together on their return, basically. I'm going to skip over this one. All right, let's talk about tax benefits for education. This one is big for us, right? Because the vast majority of the people that we see are students. So tax benefits for education are a big deal for them. All right, I'm going to kind of walk through some of the credits, eligibility, eligible expenses, scholarship income. All right, so the idea behind this, right? The government thinks, oh yes, it would be fabulous. Let's have everybody go get a college degree and let's make it a little bit less expensive for them. We'll give them some credits on their tax returns to offset that cost. There are basically two different credits that can be used. One is the American Opportunity Credit. The other is the Lifetime Learning Credit. You can only do one credit at a time for each individual. So if you have two students in your family, then you can have one student do the American Opportunity Credit and one student do the Lifetime Learning Credit, but you can't have one student that does both credits. All right. So there are two ways that education can affect a tax return. So you can have income and you can have tax credits, which reduce those, your taxable amount that you owe. All right. So the credits for education credits are calculated based on the return of the taxpayer that is qualified to claim the student as a dependent. So if they're filing them as themselves and claiming themselves as a dependent, so they're filing for themselves, they can claim it. If their parents are filing and claiming that student as a dependent, then their parents are the ones that can claim them on their tax return. So if we see any people in any clients, one of the things that we should ask is, do you know if your parents are going to claim you or can claim you as a dependent on their tax return? Because only one person can claim somebody as a dependent, whether it's themselves or somebody else that's taking care of them. There's only one dependent available. All right. So one of the ways that we know that they would potentially have tax credits for education is that those individuals should receive a Form 1098-T from their school. We always encourage people to also bring their student account statements. I know that the University of Minnesota has done a lot of work to try to make sure that the 1098-T matches the student account statement. I don't know that I would say that it's guaranteed to be that way. So I think it's always a good idea to have it so that we can check. All right. We don't have that 13614, so we won't ever have that. But we will count on the students. They will have that 1098-T if they're getting one. I believe that they can access it online. Looking at can you guys access it online? Okay. So that we can always get it that way. Schools are not required to provide this if the person is a non-resident alien. So usually, like the University of Minnesota doesn't send it to people it knows are non-resident aliens, but people can request it if it turns out they need one. All right. So an eligible institution, when we look at this credit, is any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary educational institution that participates in the Department of Education FAFSA student loan program. All right, there's a website list we can look up there. All of our big universities, if they're bringing in F and J visa holders, they're going to generally be accredited. That's not a major problem for us at all. An eligible student is the taxpayer, spouse, or their dependent who is enrolled in one or more courses as an undergraduate or graduate student. All right, and then the requirement for the courses or graduate students or undergraduate depends on the type of credit, how much you have to be enrolled for, and at what level. Stop doing that, Mario. Okay, qualified education expenses. All right, those are tuition, fees that are required for enrollment, and materials that the students are required to buy from the school. All right. These things are not exactly the same as what it takes to be a qualified education expense from a scholarship perspective, right? So to meet the criteria for the credit, it's tuition, fees, and course materials that the student has to buy from the school. Whereas for scholarships, tuition and fees, course-related expenses that are required for the courses at the eligible institution. And they must be required of all students, but it doesn't say anything about them having to be purchased from the school. So that's one of the big differences there. Qualified education expenses can also include non-academic fees, such as student activity fees or other things that are required, but that must be paid to the institution as a condition of enrollment. So stadium fee, here we go, right? That would be a good example of that. Qualified education expenses don't include room and board, sporting tickets, health insurance, transportation, and parking fees. And they are slightly different for the American Opportunity Credit and the Lifetime Learning Credit. All right, scholarships, grants, and fellowships, right? It is tax-free. We've already talked about this for non-resident aliens. It's the same, right? You've got to be a candidate for a degree, and it can't exceed the qualified education expenses, and it's not required to be spent on something that isn't qualified. And it can't represent payment for services such as for teaching or researching. If it is, then that should be reported as wages or as on 1099 for self-employment income. This is what the 1098-T looks like. So box 1 has got payments received for qualified tuition and related expenses. Box number 5, scholarships and grants. So relatively straightforward. Unfortunately, again, this is not always enough information to accurately calculate all of the credits. So asking the students for their student account statements is a best practice. And again, they don't have to, well, I already talked about that. All right, okay. So student accounts will show tuition fees and other expenses. Generally, it will show things that are purchased at the school bookstore. So on and so forth. All right. Did I put that in there? No, I didn't. Put it later. All right. So to be eligible to claim a credit. So to do that, you can't be claimed as a dependent on somebody else's tax return. You cannot be married filing separate. Your adjusted gross income must be below the limits. And the adjusted gross income is based on your filing status and the type of the credit. And you cannot be a non-resident alien. All right. So taxpayers who paid the education expenses for an eligible student can claim the education credit. So if the education expenses were paid for by a third party, and not by that dependent, they are basically considered to be paid by the dependent who can claim that student as a dependent. So let's imagine grandma pays for little Timmy's college tuition for the spring semester. All right, if Timmy is claimed by his parents as a dependent, then those parents claim those education, that money spent for those education expenses for the credit purposes. If Timmy cannot be claimed as a dependent by anybody else, then he would be the one that would claim that education credit based on that money. So it's basically that money, even though grandma spent it and sent it directly to the school, it's basically treated like it was a gift to Timmy, and then Timmy spent it on his education. That makes sense to everybody? Okay. All right. American Opportunity Credit. All right, so we're going to talk a little bit more detail about the two different credits. So the American Opportunity Credit is the best one, right? It's the highest. It's the maximum of $2,500. 40% of it is refundable, so a certain amount of it is refundable. You have up to $4,000 of qualifying expenses. So the limits are that it can only be claimed for 4 tax years. And it is your first 4 years of post-secondary education. It can only be claimed for those. So for our non-resident alien visitors, right? If you're a non-resident alien, you can't claim the education credits. And by the time you become a resident alien, right, you've been here for 5 calendar years, you're past these 4 years. So you generally will never get the American Opportunity Credit. I have seen a couple of people do it. The only way that it's worked out for them is because they came here for high school. So they were here for high school. They became a resident alien first or second year in college, and then they would then qualify for it. All right, you must be enrolled at least half time. So you only need to be enrolled at least half time for one term, academic term during the year. If you have a felony drug conviction, you are disqualified for claiming this credit. If you are married filing separate, it also disqualifies you. Again, the same 4-year thing. All right. So if the student is under age 24 and claiming the American Opportunity Credit, none of it is refundable if the taxpayer claiming the credit is under age 18, or if they were under age 18 and their income was less than half of their own support, or they were a full-time student between 18 and 24, and their earned income was still less than 1/2 of their own support, and the taxpayer has a living parent, and the taxpayer doesn't prepare a joint return. Boy. So obviously this is complicated, right? What does this mean at a high level, right? Generally, it's not going to be the students that are going to claim the credit, right? Because there's a lot of additional layers of criteria. Generally, it's going to be the parents who can claim the credit on behalf of their dependent child. The lifetime learning credit is a little bit different. This one is entirely non-refundable, but it covers undergraduate, graduate, and courses to acquire or improve job skills. So you don't have to be a degree-seeking student. It's a maximum credit of $2,000 on up to $10,000 of qualified education expenses. So it's just a straight 20% of your qualified education expenses up to that $10,000. It must be an eligible institution. Books only count if they're bought from the educational institution as a condition of enrollment. So it would be to enroll in this class, you have to go down to the school bookstore and buy this book. Not very common for them to actually meet that criteria. It's a per return. So if there are multiple students on the return, you can combine expenses up to that maximum $10,000, but you can't go over that. So it's not 10,000 per student, it's 10,000 total per return. And you can be less than a half-time student. You can just take one class, and you claim it, and that would be enough. All right. So how do you figure out which way to go? What one should you do? Start with the American Opportunity Credit. That is typically the best credit. It'll give you the more money. Are there $4,000 of qualified education expenses? Yes, go forward. If not, if the American Opportunity Credit is not available, consider the Lifetime Learning Credit. Doing that, it's not refundable. Is there going to be a liability that you can use to, that credit can reduce? All right. The taxpayers should all have that Form 1098-T. They can request it if the school didn't give it to them. Should be able to go online and get it. Very straightforward. They can submit their return without the 1098-T, but schools are supposed to provide them. So it's pretty likely that they might get a letter from the IRS saying, hey, your school didn't say that you had all of these education expenses, so show me some proof of that, please. The student account statement would be fabulous as proof. It would also be good for us to use so that we could confirm the information on their 1098-T. If they have a scholarship or fellowship grant, so if their expenses are $10,000 and they have a grant of $5,000, right? That means that they have $5,000 of eligible expenses, right? Because that first $5,000 was offset by their scholarship or fellowship. All right. Here's a comparison. Publication 4012 in the back, it's got a whole tab on the education credits, so you can go through that. There's all kinds of stuff. All right. More about the 1098-T. I think I've already talked about this. Yes, you have to request it. Right. Sometimes there can be adjustments. So if say the student drops a class or makes a change in their enrollment or registration, there might be an adjustment for either the amounts paid or for scholarships or grants. Those are out of scope for us. So we will say, enter them into TaxSlayer, and here's the IRS publication about education credits for you to figure out how to enter those. The other thing to note, remember, is that taxpayers are cash basis. So expenses paid in December 2023 for the spring 2024 semester are 2023 expenses. Because what matters is, when did the money go out? When does the payment actually happen? I already mentioned the reducing. All right. Some guidance about analyzing the expenses. These should look familiar. All right. So a couple of examples, right? Student health insurance, not an eligible expense. UPass transportation fee, transportation benefit, not an eligible expense. If you drop a class and that's taken out, that would not be included as an eligible expense, right? Because you dropped it. So it's a credit. All right. So as a reminder, so when we look at this, so we would take whatever payments were received for tuition, we would subtract any scholarships or fellowship grants that were received to find eligible expenses for the credits. So here, $9,900 of payments, $5,360 for grants, $4,540 for eligible expenses. Make sure, so how do I? Yeah. If you can't, so the way you say it here is maybe the other side. So if you've $10,000 of education expenses that you have to pay for, if you get scholarship for $5,000, but you take out a $10,000 withdrawal from your 529, which is a college savings account. You now have $15,000 of income, but only $10,000 of education expenses, right? So you can't like double count your income or how you're paying for those expenses. You can only pay for them with money, with one time, basically, is the way to say that. All right. We've already gone through that. All right, scholarship and fellowship, right? So money paid for you on your behalf to aid in your pursuit of your study or your study and research. Generally, it can be for tuition and other fees. It can also, a scholarship or fellowship or grant can be for other purposes, right? It can be living expenses. Totally fine. All right. But if it meets the requirements to be excluded, so it is for that tuition required fees, then it is not taxable. If it is for something else, it is taxable income. So no treaty exemptions allowed for US residents. It's basically all going to be taxable. So in this example here, we changed the numbers around. She had payments of $9,900 for tuition. She received a scholarship grant for $13,400. This means that she has scholarship income of $3,500. Okay, that's how that one would look. All right. It is getting sort of late, so I'm going to summarize this, right? Although it may seem counterintuitive, there can be times when not taking a scholarship as being taxable so that you can count an expense for a credit may be to your advantage. If, for example, you're getting a 100% match on a credit for every, so like $1,000 of expenses, and you get $1,000 of credit. But if you took $1,000 of income, you would only have to pay 10%. So you'd pay $100 in tax to get $1,000 of credit. That would be a good deal. If you had to take, if you had to pay, let's say, $300 in tax to get $200 of a credit, that would not be such a good deal. That would be something like the lifetime learning credit, where the percentage is not nearly as good. So there can be some calculations and some kind of evaluations that go into figuring out what is the best option for how to maximize your credits and minimize your overall tax. And that is totally fine to do. And that is absolutely fine for our clients if they want to play around with how they report how much is a taxable scholarship and a qualified education expense and how much is just offset down to zero. That is completely fine for them to do. That is not something that we will do for them at our tax clinics. All right, but that is definitely something that they could do. That is something that other tax clinics do, right? If they're a resident, maybe they can go somewhere that does returns for them and they can go through that calculation for them. All right. All right. This is kind of the criteria. Basically, sometimes it's very obvious what is best. Other times it is not very obvious what's best. There are a couple of rules of thumb about what's most likely going to be the best option for them. But it's not going to always be the case. Again, if they really want to know, they can mess around in the software to figure out what's going to be the best option. And we can do that as well. And then finally, when students are dependents, which many of our students will be, right? In an ideal world, it would be best if their parents were here, right? So that everybody could do their returns and everybody could figure out, what is going to be the best way to do this? Who should be claimed as a dependent? Who should not be claimed as a dependent? How are the credits going to work, right? We can't really do that for them. We can't make them do that. all we can really do is encourage them to try to have a conversation with whoever it is that might be able to claim them as a dependent, to say that, you know, you guys should talk about it and figure out a plan together to try to minimize the amount of tax that everybody pays. People that want to file on their own can, but that can have some pretty severe tax consequences for whoever was going to claim them as a dependent and now no longer can. They have to file on paper. Yes, it takes a long time to get that straightened out. So, enough said on that. Okay. Kitty tax. All right. The idea behind the kitty tax is if a child has a lot of income, rather than having the child file the tax return, the parent can report that income for them. They can just put it on the parent's return, which is great, except that it gets taxed at the higher rate. And there is a form, this 8615, that has to be filed. Lucky for us, 8615 is out of scope, so we don't have to worry about it, right? And the questions are, does the dependent have over $2,300 of unearned income, including taxable scholarship income? And then the second one is, will the dependent file a return? So if you answer yes to both questions, you have to do this 8615 and it's out of scope. If you answer no, either because there is less than that in unearned income or the dependent's going to file a return, then it's not required and we can help them. Pretty straightforward. All right. And with that, we're going to go into finishing the return really quickly. So just a couple words about like the differences in the models, right? Because a lot of the traditional things for finishing a return are based on the traditional VITA model, where you have a 13614C, you know, it's the interview process. You double check that document versus the document income documents versus the return. And we don't have that, right? We don't have that 13614C. The taxpayers, the one with the documents, they would double check their own return. In a traditional model, the mandatory quality review by a different VITA volunteer, right? We don't have that. We do have the optional but strongly encouraged quality review by a VITA volunteer, but we can't make them. As a part of the traditional VITA model, right, we would have a conversation with the client. Are you going to get a refund by check? Do you want it direct deposited? If you owe money, how do you want to pay? For the FSA model, the taxpayer does all of that, right, is the filing process. They put all of that information in. For a traditional VITA model, right, the taxpayer doesn't have access to that return after they leave the tax clinic. So one of the key things is that they have to print out a copy of that return so that the client has one. Otherwise, they won't have any information about it. And they would print out another copy if they have to paper file. Whereas for us, we don't have to worry about that, right? They either e-file on their own or they print their own copies and then mail those in for themselves. When the traditional VITA model has an e-file, the person signs an e-file authorization form and then the IRS VITA volunteer does the e-filing. And then they fix the issues. If it's a small enough issue, they can fix it themselves. If it's a big enough issue, then they have to get the taxpayer involved again. And we will help as part of the FSA clinic. We can help fix returns and help fix filing errors. But we're not the ones doing that, right? We're the ones that are saying, okay, this error means that you didn't fill out your Schedule OI. So go back in and do that. And now you'll be able to file successfully. All right. We always want to encourage everybody to get direct deposit. It's always so much faster. The money doesn't get lost. Doesn't matter if you move. You can split the money if you want. If you are getting the earned income tax credit or additional child tax credit, which are the refundable ones, the IRS does not process refunds until after February 15th. It's not a problem for us. We're not usually doing returns until right about that time anyway. All right. Banking information for direct deposit. Making sure that that information is right is very, very important though. It can delay the refunds by several months, not weeks. If that money goes to the wrong person, then it is going to be, it can be gotten back, but it is not easy to do. All right. We've already talked about all of the ways to pay. all of that. So we didn't really talk about extensions, right? People can file a request for an extension if they say, I'm not going to be ready, I don't want to file. They can do a request for extension until October 15th. It's an extension of time to file. It's not an extension of time to pay. So they still need to pay all of their money that's going to be due. Even if they don't know, they can guess. If they don't pay everything by that original due date, then they will have some additional penalties and interest that they will have to pay. If they owe money and they can't pay it, they can request 120 days just on the IRS website. There's no fee for that, although penalties and interest do continue to accrue as well. If they need a larger amount or more time, they can request an installment agreement. There's a fee to set that up. And again, interest and penalties keep going until you pay all them. Basically, until you pay, the IRS charges you more. And the IRS charges you lots. State quality review. So on this one here, I think the main thing to note, right, is that we would like our clients to get a quality review, right? We can't make them do that, but that is one of our major jobs as a volunteer at an FSA site, is to help make sure that the returns that are sent are correct, right? We don't have a 13614 to help us with the quality review, so we need to look at our income documents and ask the questions of the taxpayer. We are not going to go through the software like line by line, item by item to see what they've entered, right? We want to get a PDF of their return, look at their income documents and compare it to that PDF. We don't have access to the returns once we're done, right? It's always going to be under the taxpayer's control, but they can download the PDF of those returns for their records or to print it out. The other thing that we would say is when you're doing a review with a client, right? Number one, make sure that, right, think about it from their perspective, right? They have probably never filed a tax return before. So if there's a mistake, that's okay. It's not a big deal, right? That's exactly why we do quality reviews. We're really glad we got it to make sure that your return is correct. One of the most important things that you can do is to help explain the mistakes to them so that they understand what went wrong, so that next time when they're here in a year again, they can fix it and they don't have that problem, right? Be kind to them when they make mistakes, right? Some of the mistakes they make are going to feel very silly, but they really just don't know. And make sure when you end to ask if they have any other questions, right? Because usually there can be questions, especially what do I do about next year? How is this going to work? All of that kind of stuff. We want to make sure they know what's going to happen. And thank them for coming to visit us, right? They didn't have to come. This is how we get pizza and canes. So make sure we say thank you. All right. A couple more things and then we're going to wrap it up for tonight. So we can talk about, like, if they owe a lot of money, they can make adjustments on their W-4 so that more money is taken out of their paycheck. Or if they don't have a regular paycheck, like if they have a fellowship, they can make estimated payments so they don't owe so much money. It's a good idea so that they don't have to come up with a large amount of money at the very end. If they're getting a really big refund, you can also reduce your withholding so that you don't get such a big refund. That gives you more money every paycheck, which is really nice. All right. If we have anybody that's self-employed, we can talk to them about tracking their expenses, right? Having good documentation is really important when it comes to tax return preparation time, especially important if it comes to an IRS letter time when they want to see some information, some supporting information. Sometimes if they have problems with the IRS, so once it's gone kind of from us, right? We've sent it in, we've submitted it, the IRS sends them a letter that says, we don't like this, we made this change, we want to see this documentation for whatever. That's kind of beyond what we can do. We can kind of say, oh yeah, we think that maybe they were right or they're wrong, but we can't really help them beyond that. However, there is another part of the IRS program called a low-income taxpayer clinic, LITC, that basically will help with controversy. So when the taxpayer and the IRS have a dispute, a disagreement, they can help that taxpayer. There's one here at the U of M. We've got their contact information. We can refer, we have, and we can, and we will refer clients over to them. I also have approval from the guy that we can send people from other places as well. And if he can't help them, so other students at other schools, if he can't help them, then he can refer them through the LITC network to whoever is going to be the closest to them that would be able to help. So if there is somebody that is having a problem, that is a way to get them, right? They are law students, but they're supervised by a licensed attorney. So this is like very high quality tax legal advice. All right. Any questions? It's a lot to do this after the non-resident stuff. Oh no. All right. Okay. I'm gonna skip this. We're almost at 8:30. I'm skipping this. I was gonna go in, I was gonna show you some stuff in TaxSlayer Pro, but I'm gonna skip it. I'm gonna skip Dear Iris. All right, yes, I'm gonna skip that. I'm gonna make Dear Iris things a quiz. That's what I'm gonna do. All right, okay. Here we are, ending our training for today. Let's talk about next steps. Again, so when Lincoln Learn goes live, everybody will know. We've done modules, pardon me, 1 through 5 so far for the resident course. All right, so there are going to be modules 6 through 9 that I'm going to release in the next couple of days, so over the course of the days. 6 is credits, refundable and non-refundable. Module 7 is education benefits. Module 8 is going to be Dear Iris and a publication 4012 treasure hunt, right? So for the resident test, that's one of the most important things that you need to be able to do is go find information in your 4012. So you're going to get some practice doing that. And then we'll do a few practice return assignments. I've kind of been delaying on that because I keep seeing emails of, oh, the education credits don't work. Oh, retirement income stuff is not working. So I don't know that I can delay any longer. All right, but that's the plan. And that's the end. All right. I am going to stop. I'm going to stop. I'm going to stop the share. All right. Okay. Hello out there in Zoom land, people. Does anybody have any other questions before we wrap things up today on the resident side? Is everybody as brain dead as I am after 3 hours of taxes? It is tough. Maybe we should do resident first. Maybe not. Maybe not. Okay. All right. Well, with that, thank you everyone for joining us today. I'm going to stop the recording and